Most traders don't lose money because they entered badly. They lose money because they leave badly. That sounds backwards, doesn't it? You've been taught to obsess over entries, find the perfect setup, the perfect confirmation, the perfect timing. But let me ask you something. How many times have you been right about the direction and still walked away with almost nothing? Or worse, how many times did you exit a winning trade too early, only to watch the market continue exactly where you originally thought it would go? That frustration is not accidental. It reveals something deeper about the way most people approach risk, fear, and uncertainty. The market does not pay you for being correct. It pays you for sitting correctly, and very few traders understand the difference. You can study charts for years and still miss this, because the real battle begins after the entry, not before it. When you first enter a trade, your mind is clear. The decision feels logical, structured. You saw a breakout, a compression, a shift in volume. Maybe the market finally aligned with your thesis. But the moment price starts moving, something changes. Now the trade is no longer an idea. It becomes emotional property. Every tick against you feels personal. Every pullback feels dangerous. Every small profit starts whispering the same seductive sentence. Take it before it disappears. Have you noticed that? The market can move 10 points in your favor, and suddenly your thinking changes completely. A trader who was patient before entry becomes nervous after entry. Why? Because unrealized profit creates fear just as quickly as unrealized loss. That's one of the great contradictions in speculation. People think greed causes most bad exits. In reality, fear does. Fear of losing open profit. Fear of giving back gains. Fear of being wrong after being right. And because of that fear, traders consistently cut their strongest opportunities short while allowing weak positions too much room to breathe. Think about the damage this creates over time. One large trend could pay for 10 small losses. But if you repeatedly exit those trends at the first sign of discomfort, your entire mathematical edge disappears. You become dependent on perfect accuracy because you never allow asymmetry to work in your favor. That is an exhausting way to trade. Now here's the dangerous part. The market will occasionally reward bad exits. This confuses traders even more. You'll take profits early, the market reverses afterward, and suddenly your emotional reaction says, "Good decision." But was it? Or were you simply lucky that fear happened to align with temporary market movement? You must separate outcome from process. That distinction changes everything. A disciplined exit is not measured by whether the market reversed afterward. It is measured by whether your decision matched the structure, behavior, and conditions that justified the trade in the first place. Most traders never build that framework. Instead, they react candle by candle. One red candle after 3 green candles. Panic, a sharp wick against position. Anxiety, small consolidation after expansion. Exit immediately. But strong trends rarely move in straight lines. Real institutional movement breathes. It pauses. It traps. It rotates liquidity before continuation. If you do not understand this behavior, you will continuously mistake healthy movement for danger. And then you'll say something many traders say for years. I always exit too early. But early compared to what? Compared to the full move afterward. That's hindsight. The real issue is usually this: your exit logic is weaker than your entry logic. You spent hours planning the trade and seconds managing the exit. Let me ask you another question. Do you know exactly what behavior would invalidate your trade before you enter it? Not emotionally invalidate it. Structurally invalidate it. There's a difference. A trade should not end because you feel nervous. It should end because the market violated the conditions that made the opportunity attractive in the first place. Maybe momentum failed. Maybe volume collapsed. Maybe higher time frame structure shifted. Maybe the breakout reclaimed prior range and acceptance returned. Those are reasons. But emotional discomfort disguised as caution. That's where profits disappear. Now, this doesn't mean holding blindly. Some traders hear discussions about patience and immediately become stubborn holders. That's another form of emotional trading. The goal is not to hold forever. The goal is to hold rationally. A professional trader understands that exits exist on a spectrum. There are defensive exits, trailing exits, structural exits, volatility exits. Each one serves a different purpose, but all of them require one thing most traders avoid: predefined thinking. You must decide more in advance and react less in real time, because once the trade is active, your mind becomes unreliable. That's not weakness, that's human nature. The brain perceives uncertainty as threat, and trading as concentrated uncertainty. So what happens? You begin negotiating with yourself. You move targets closer. You tighten stops emotionally. You watch lower time frames, obsessively searching for reasons to escape. A trader enters from conviction and exits from tension. That inconsistency drains accounts slowly, not dramatically. And here's what makes this especially painful: the market often showed signs that the move was unfinished. You simply didn't recognize them. For example, strong trends tend to leave clues: continuation volume after pullbacks, failed reversals, shallow retracements, persistent bid support, compression near highs instead of aggressive rejection. Have you noticed how powerful markets often refuse to retrace deeply? That behavior matters. It tells you participants are willing to buy aggressively without waiting for discount pricing. Weak traders see a pause and think reversal. Experienced traders ask a different question: who is trapped here? That question changes perspective, because markets move through pressure. Short covering creates fuel. Late buyers create liquidity. Weak hands create movement, and when you exit too early, you often become part of the liquidity that stronger participants use to continue the trend. That realization can be uncomfortable, but necessary. Now, there's another layer most people ignore. Your exits reveal your self-image as a trader. Someone who believes they must constantly protect themselves will almost always take profits too quickly. Not because the chart demanded it, but because psychologically they don't trust themselves to handle uncertainty. That lack of trust leaks into execution. You'll hear traders say, "I just wanted to secure something." On the surface, that sounds responsible. Sometimes it is, but sometimes it's fear wearing professional clothing. The market punishes hidden fear, not immediately, quietly, trade after trade, month after month, until you look back and realize your analysis was often correct, but your management never allowed the analysis to fully express itself. This is why great traders appear unusually calm during positions. It's not because they feel nothing. It's because they already accepted the uncertainty before entering. That changes behavior completely. A trader who accepts risk observes more clearly. A trader who fears loss interprets every fluctuation emotionally. Same chart, different mind. And once you understand this, you stop asking, "How do I avoid losing profits?" Instead, you begin asking, "What behavior suggests the opportunity still exists?" That is a far more intelligent question. Because markets are not random emotional events. They are auctions driven by participation, imbalance, and positioning. Your job is not to predict every tick. Your job is to stay aligned with behavior for as long as evidence supports continuation. Sometimes that means enduring uncomfortable pullbacks. Sometimes it means sitting through slow consolidation while everyone else grows impatient. Sometimes it means resisting the urge to feel productive by constantly closing and reopening positions. And that last point matters more than most realize. Many traders are addicted to the feeling of completion. Closing trades give psychological relief. It creates certainty, finality, control. But profitable trends often require the opposite experience: open uncertainty, unfinished tension, the willingness to remain involved while the market reveals more information. And most people cannot tolerate that long enough to capture exceptional movement, so they settle for fragments, small pieces of larger opportunities, again and again, until eventually they begin believing the market itself is the problem, when in reality the issue began much earlier, in the inability to distinguish danger from discomfort, because the two are not the same. Most traders spend years trying to perfect their entries, believing precision is the secret behind consistent profits. They search for the exact candle, the perfect confirmation, the cleanest setup. But the market has a strange way of humbling that obsession, because a trader can enter almost perfectly and still fail to make meaningful money. Why? Because precision gets you into the move. Patience is what allows you to benefit from it. Look closely at how most traders behave after entering a winning trade. The moment price moves slightly in their favor, their focus changes completely. Before entry, they were confident, calm, analytical. But once profit appears on the screen, fear quietly takes control. Not fear of losing money, fear of losing profit. That fear is subtle, which makes it dangerous. It convinces traders they are being responsible when they are actually reacting emotionally. So they close the trade early, secure a small gain, and feel temporary relief. Then the market continues moving exactly as they originally expected. Have you experienced that frustration? Watching the market run without you after you exited too soon. That feeling is not caused by bad analysis. It usually comes from impatience disguised as discipline. The market rarely rewards nervous hands. Strong moves need time to develop. Institutional participation unfolds gradually. Trends expand, pause, retrace, and continue. But impatient traders interpret every pause as danger. A small pullback feels like the beginning of a reversal. One red candle inside an uptrend suddenly looks threatening. Experienced traders see those moments differently. They understand that healthy trends breathe. They know markets do not move in straight lines for the comfort of retail traders. In fact, the market often creates discomfort intentionally because emotional traders provide liquidity through premature exits. That changes how you should think about patience. Patience is not passive waiting. It is active emotional control. It is the ability to stay aligned with the original reasoning behind the trade while temporary fluctuations attempt to shake your confidence. That requires far more skill than finding an entry pattern. Anyone can click buy or sell. Very few can sit through uncertainty without sabotaging themselves. And this is where many traders misunderstand risk management. They think taking profits quickly automatically makes them safer. Sometimes it does. But constantly cutting trades short creates another kind of risk. The risk of never allowing your winners to outweigh your losses. A trader who takes small profits repeatedly must maintain extremely high accuracy just to survive. One mistake can erase several successful trades. But a patient trader understands something important. One properly held trend can compensate for multiple small losses. That is how asymmetry works in trading. Small controlled losses, larger sustained gains. But those larger gains cannot happen if impatience keeps interrupting the process. Watch the behavior of powerful markets. Strong trends often show continuation signs long before the biggest expansion occurs. Tight consolidations near highs, weak pullbacks, persistent buying pressure after dips. These behaviors suggest strength, but impatient traders rarely stay long enough to benefit from them. Why? Because they crave certainty more than opportunity. The need to feel safe becomes stronger than the willingness to follow evidence. So they exit not because the market invalidated the trade, but because holding the position became emotionally uncomfortable. That discomfort is part of trading. There is no meaningful trend capture without temporary uncertainty. The trader who understands this stops reacting to every movement and starts observing behavior with more clarity. And over time, they discover something most traders never truly learn. The biggest money is rarely made in the entry. It is made in the ability to remain patient while the market continues proving you right. Most traders do not lose their biggest opportunities because they misunderstood the market. They lose them because they misunderstood themselves. The chart was right in front of them. The direction was correct. The setup worked, but somewhere between the entry and the exit, emotion quietly took control. And that is where profits disappear. Not from bad analysis, from emotional exits. This is one of the most expensive habits in trading because it feels reasonable while it's happening. A trader exits a position early and tells himself he is being cautious, responsible, disciplined. But many times, the decision is not coming from discipline at all. It is coming from fear. Fear changes how traders interpret information. A normal pullback suddenly feels dangerous. A pause in momentum feels like a reversal. One aggressive candle against the position creates panic even when the overall structure remains intact. Have you noticed how quickly confidence disappears once real money is involved? Before entering the trade, everything seems clear. The setup makes sense. The risk is acceptable. But after entry, emotions begin negotiating against the original plan. The trader who confidently predicted the move now wants to escape at the first sign of discomfort. That shift is psychological, not technical. The market exposes emotional instability faster than almost any profession. It reveals whether you truly trust your process or whether you only trust it when conditions feel comfortable. And comfortable conditions rarely produce exceptional trades. The irony is that many emotional exits happen during winning trades, not losing ones. A trader sees open profit and suddenly becomes protective. Instead of asking whether the trend is still healthy, he asks how quickly he can secure something before the market takes it away. That mindset creates a pattern. Small profits, premature exits, endless frustration. Then comes the painful part. The market continues moving exactly in the original direction after the trader exits. This happens so often that traders begin feeling cursed. But it is not bad luck. It is emotional decision-making repeated consistently. The market rewards stability. Most people think emotional trading means panic buying or revenge trading. But emotional exits are often quieter than that, more subtle, more socially acceptable. A trader closes early and says, "I didn't want to be greedy." But greed was never the issue. The issue was emotional discomfort. Strong trends require patience, and patience becomes impossible when fear controls interpretation. Every small fluctuation starts looking meaningful. Traders zoom into lower time frames, searching for reasons to justify leaving the position. Not because the market changed, but because emotionally they want certainty. That need for certainty destroys positioning. Professional traders understand that open profit is not the same as realized profit yet. They know markets fluctuate naturally. Strong movements often include pullbacks, pauses, and temporary weakness before continuation. If you cannot emotionally tolerate those moments, you will continuously exit before the real expansion occurs, and the market notices weak hands quickly. Look at how trends behave after shaking traders out. Price pulls back just enough to trigger fear, force exits, and clear weak positioning before continuing higher. Emotional traders interpret that movement as danger. Experienced traders often interpret it as confirmation. That difference in interpretation changes everything. Because trading is not just chart reading, it is behavior reading. You are reading market behavior while simultaneously managing your own behavior. Most traders focus entirely on the first part and ignore the second. That imbalance creates inconsistency. A trader may have excellent analysis, but still fail financially because emotion interrupts execution. This is why exits deserve more attention than entries. Entries are moments. Exits are processes. Most traders believe fear exists only when they are losing money. That is not true. Fear becomes even more dangerous when they are making money. The moment a trade moves into profit, something changes psychologically. The trader who was patient before entry suddenly becomes tense. Calm analysis disappears, and emotional protection takes over. Every small fluctuation starts feeling important because now there is something to lose. Open profit creates pressure, and that pressure exposes weakness faster than loss itself. Have you noticed how traders often handle losing trades and winning trades backwards? They hold losing positions hoping the market will recover, but they rush to close winning trades the moment uncertainty appears. That behavior is not logical. It is emotional survival instinct. A small unrealized profit feels fragile. Traders become obsessed with protecting it. So instead of allowing the trade room to develop naturally, they interfere constantly. They tighten stops emotionally. They reduce targets. They exit on normal pullbacks. Then the market continues moving without them, again and again. This is why fear protects small gains while quietly destroying large opportunities. The market rarely rewards people who need immediate emotional comfort. Strong trends require tolerance for uncertainty. Even healthy movements contain pauses, retracements, and temporary weakness. But fearful traders interpret these normal behaviors as threats because they are emotionally attached to their open profit. That attachment changes decision-making. Instead of asking, "Is the trade still structurally valid?" they begin asking, "How quickly can I secure this before it disappears?" Those are completely different mindsets. The first mindset follows evidence. The second follows fear. And fear has a strange way of disguising itself as intelligence. Traders convince themselves they are being disciplined, when in reality they are simply uncomfortable holding risk. They say things like, "No one ever went broke taking profits." Technically true, but many traders go nowhere financially because they only take profits too early. There is a major difference. Consistent profitability in trading does not come from constantly being right. It comes from allowing strong trades to significantly outweigh controlled losses. That balance becomes impossible when fear keeps shrinking every winner before it fully develops. Think about the mathematics behind it. A trader risks 1 unit to potentially gain 4 or 5. But if fear causes him to close every trade at 1 unit of profit, the entire advantage disappears. Now the trader needs extremely high accuracy just to survive. That creates stress. And stressed traders become even more fearful. The cycle feeds itself. What makes this problem worse is that markets often test conviction before continuation. Strong trends frequently pull back just enough to create doubt. Weak traders interpret this as reversal and exit. Experienced traders understand that temporary discomfort is often part of trend behavior. That understanding changes emotional response. A patient trader does not react emotionally to every candle because he already expects fluctuations. He understands that the market moves through waves of participation, not straight lines designed for emotional comfort. Fearful traders expect smooth movement. Professional traders expect resistance, hesitation, and volatility inside trends. That expectation creates emotional stability, and emotional stability allows better decision-making. Look carefully at powerful market moves. The biggest trends usually do not reward impulsive management. They reward controlled patience. They reward traders who can distinguish between structural weakness and emotional discomfort. Most people never learn that distinction. To them, discomfort automatically means danger. So the moment profit appears, their main objective becomes escaping uncertainty rather than maximizing opportunity. They focus more on avoiding emotional pain than following market behavior. That is why so many traders consistently capture the smallest part of the move. Not because the market was unclear, because fear convinced them survival mattered more than positioning. A trader can spend hours finding the perfect entry and still fail to make money from the trade. That truth frustrates many people because trading culture places enormous attention on entries. Traders search endlessly for the ideal setup, the exact confirmation, the perfect timing. They believe precision at entry is what separates winning traders from losing ones. But a good entry alone means very little if the exit lacks discipline, structure, and patience. The market does not reward you simply for entering correctly. It rewards you for managing correctly after entry. And that is where most traders fall apart. Have you ever entered a trade perfectly, watched it move in your direction, then exited too early only to see the market continue without you? That experience is extremely common, not because traders cannot analyze markets, but because they cannot manage emotions once money becomes involved. Before entry, thinking is usually objective. The setup looks clean, risk feels acceptable. The trade plan appears logical. After entry, emotions begin interfering. Now every candle feels personal. Every pullback creates doubt. Every small profit triggers fear of losing what has already been gained. Suddenly, the trader who entered confidently starts reacting emotionally to normal market movement. This is why a strong entry cannot save weak trade management. A weak exit destroys opportunity quietly, not dramatically. A trader closes early, secures a small gain, and feels temporary relief. But relief is not the same as good execution. Many traders confuse emotional comfort with intelligent decision-making. That confusion costs them the larger move. Strong trends almost never move in straight lines. Markets pause, retrace, consolidate, and continue. This behavior is normal. But traders with weak exit discipline interpret every temporary slowdown as a signal to escape. Why? Because uncertainty becomes emotionally uncomfortable. And once discomfort appears, the mind starts searching for justification to close the trade. One small bearish candle suddenly looks dangerous. A minor pullback feels like the beginning of a reversal. Traders zoom into lower time frames looking for reasons to confirm their fear. The problem is not technical analysis at that moment. The problem is emotional instability. A trader with a precise entry but poor emotional control will often underperform someone with average entries and strong management. That sounds strange to inexperienced traders, but it is true. Why? Because large profits come from sustained participation, not perfect timing. The biggest money in trading is usually made by staying aligned with a valid move long enough for expansion to occur. But weak exits interrupt that process constantly. Traders leave too soon, re-enter emotionally, chase movement, and lose consistency. The market becomes exhausting. Not because opportunities are absent, but because execution lacks structure. Professional traders understand something many beginners ignore: exits should be planned with as much detail as entries. Before entering a position, they already know what behavior would invalidate the trade. They understand where continuation remains healthy and where actual weakness begins. That preparation creates stability. Without it, traders react impulsively, and impulsive exits often come from fear rather than evidence. There is another danger hidden inside weak exits. Sometimes the market reverses after you close early, and this tricks you into believing your emotional reaction was correct. But a good outcome does not automatically mean a good decision. A fearful exit that happens to work once can still damage long-term performance. Because over time, repeated premature exits destroy risk to reward balance. Small wins cannot consistently compensate for losses if larger opportunities are never allowed to develop. This is where many traders misunderstand discipline. Discipline is not closing trades quickly to feel safe. Discipline is following market evidence instead of emotional pressure. That requires patience. It requires the ability to tolerate temporary uncertainty without abandoning the original reasoning behind the trade. Most traders never develop this skill because they spend all their energy trying to improve entries while ignoring the psychology required to manage positions properly. And eventually they discover something painful. The market was not denying them opportunity. Most traders believe they make decisions based on charts. In reality, many decisions are made based on emotion first, with charts used afterward as justification. This becomes especially dangerous during exits. A trader enters with a clear plan. The setup makes sense. The risk is defined. But once the trade becomes active, emotions begin influencing perception. The same chart that looked logical before entry suddenly feels uncertain because now money is involved. That shift changes behavior immediately. A small pullback becomes threatening. A pause in momentum feels suspicious. One aggressive candle against the position creates anxiety, even when the larger structure remains completely intact. Have you noticed how traders often abandon positions during normal market movement, then regret it minutes later? That reaction rarely comes from evidence. It usually comes from emotional discomfort. The market did not necessarily change. The trader's emotional state changed, and emotional states distort interpretation. This is why two traders can look at the exact same chart and respond completely differently. One sees healthy consolidation inside a trend. The other sees danger and exits immediately. One trusts structure. The other reacts to fear. The difference is not intelligence. It is emotional control. Strong traders understand that markets naturally fluctuate. Trends breathe. They expand, retrace, pause, and continue. Temporary weakness does not automatically mean the opportunity is over. But emotional traders struggle to tolerate uncertainty. They need constant reassurance. The moment reassurance disappears, they begin searching for reasons to escape the trade. That search creates bias. Suddenly every candle against the position feels more important than every candle supporting it. Traders start focusing only on negative information because fear narrows perception. They stop evaluating behavior objectively and begin reacting emotionally. This is why emotional exits often feel urgent. The trader convinces himself action is necessary immediately. Close the trade. Protect the void, the pain. But urgency inside trading is often emotional, not structural. Markets rarely require panic. Emotions do. And when traders repeatedly exit from emotion instead of evidence, they slowly destroy their own edge. Not because their analysis is poor, but because they never allow the analysis enough time to fully develop. That creates a painful pattern. Correct direction. Weak execution. Again and again. Then frustration grows. Traders begin questioning strategies, indicators, or market conditions when the real issue is much deeper. Their exits are being controlled by emotional reactions rather than market behavior. Look carefully at what usually happens after emotional exits. The market often continues moving in the original direction. Why? Because the trend itself was still healthy. The trader simply confused temporary discomfort with actual weakness. That confusion is extremely expensive. Professional traders approach exits differently.